possibly way earlier than that if you are farther west, and for making time in the day if you are farther. It's good to see that there are people in the audience. I mean, do people think we should just get going or wait for any more people who may be logging in?
I can just put something up on Twitter. Do we have a link to drop on Twitter?
Yeah,
Oh, because this is
I
like
don't.
registration only.
Yeah, this is registration only.
Oof.
All right.
Gatekeepers.
Well, okay, then I will get things going. Welcome everyone, panelists and attendees who are coming in now at a reasonable clip. This panel is titled Heterodox Topics in Money, and we have 4 presentations looking at various aspects of monetary policy and money as a thing and money as an institution. So I am Nina Eihecker. I'm at the University of Rhode Island. As I said, I'm delighted that that my co-panelists agreed to present these topics that they're talking about. I think this is going to be interesting, and I hope that people in the audience feel the same way. So the first session, or the first talk, is going to be by me. It's titled Monetary Power and Fiscal Expenditure. The title in the program talks a lot about the structuralist view of money, but the paper as it is evolving is a little bit more open-ended about how we're going to approach money in a post-Keynesian view. The second presentation by Devika Dutt is titled Exorbitant Privilege of Ultimate Responsibility, Access to the International Lender of Last Resort. Our third presentation is by Nathaniel Klein at the University of Redlands, Monetary Hierarchies in Economic Thought, Articulating Power in Monetary Theory. And our fourth presentation by Alex Williams is Deleuzian Tools for Monetary Economics. So I will, I guess, just get things going. Let me share my screen. There we go. Okay. So this first presentation is fiscal expenditure, and as I said, the formal title is The Structuralist Approach to Money, though in practice it's more open-ended in terms of which approach to endogenous money we're going to talk about, and the paper will get, or the presentation will get more into those details. It's about liquidity preference, endogenous money, and how we can begin to account for the government as a spender in the economy and a provider of liquidity. So the arrangement up to 20 minutes per presentation with 5 minutes of question and answer per speaker, and then we'll have 20 minutes at least of conversation after all panelists are done presenting. So I'm going to start my timer and I'll just get going. Okay. So this project of mine is thinking specifically about how governments, separate from and in tandem with monetary authorities, can affect the quantity of money in circulation in an economy. And it's also thinking about how banks function vis-a-vis governments. So if governments have the ability to potentially affect the quantity of money in circulation, what implications might that have for the financial and monetary system at large? And then what happens if a government's specific ability to deficit spend or to fund expenditure via sovereign debt or use its fiscal powers to provide liquidity to banks is hindered? The context for this project stems in great part from the 2008 financial crisis and its evolution into the Eurozone crisis in Europe. And it also has to do with the CARES Act and different measures that governments around the world have taken to support domestic banking systems in the context of the big shutdown that occurred in March of 2020. And so specifically, it's looking to consider the general importance of government bonds in monetary policy, which is typically indirect, but is occasionally direct if we think about the government as a body that can lend or guarantee assets and liabilities of financial institutions at large. We also want to, it also allows for considering the potential constraints that other governmental bodies might face in extending these sorts of accommodative practices. So we might contrast here municipal versus federal practices in the US. We might consider the need for extraordinary action even at the federal level in the US. And there's work by Simon Mohan going into this in the sort of looking at effectively the government in the money view. And then also thinking about divergent experiences in Europe between core and peripheral members of the Eurozone. And then if we want to think more broadly, and I believe Dr. Jutt will get into this in greater detail in her presentation, we can also extend this to emerging market versus developed economies, especially if we begin to think about exorbitant privilege and the ease of placing debt with private creditors. So some links to recent scholarship. I think there are similarities to the framework that Perry Meerling elaborates in the money view, thinking about the financial and monetary system as a set of interlinked balance sheets in which loans and payments generate deposits elsewhere in the system, rather than a monetary authority having sole responsibility for the quantity of money circulating in an economy. It also allows for considering the importance of banks and other financial intermediaries and non-financial entities, households and firms, as well as policymakers in determining the quantity of money in circulation. There's also a growing literature about the importance of repo funding operations and the importance of sovereign bonds linking fiscal policy and monetary operations. And Daniela Gabor has written amply with others about also an enabler of expenditure and so on, and thinking there about, again, these links between monetary and fiscal policy. And then I also think that this has implications for the debate over the theory and feasibility of functional finance and or modern monetary theory. So it may be that some economies are well positioned to engage in accommodative monetary funding of different types of bank activity and different government expenditure, while other economies may be more constrained in the global system for one reason or another. So the theoretical framework for this project is different post-Keynesian approaches to endogenous money, which basically notes that monetary authorities are not solely responsible for money in circulation at the economy-wide level. Banks' relative willingness to lend, hold non-loan assets, or hold excess cash or excess reserves matters when we think about the quantity of money in circulation. And households and firms' willingness to hold cash, other liquid assets, and more illiquid assets matter as well. And finally, expenditure can increase money in circulation, and payment of liabilities may resolve those circuits of funding. So if we think about models of reflux, payment, and expenditure, thinking about loops that open and loops that close, and how all of those fit into the sort of broader monetary, system as a whole. Meerling's money view of the economy views the economy as a system of interlocking balance sheets. So we can think about a bank's willingness to provide credit to an actor to engage in expenditure on something will generate deposits and more money across the system. Expenditure by one actor yields deposits elsewhere, and the resolution of those transactions may end loops while extension of credit enables more expenditure. And then we see these dual dynamics of expenditure and lending as generators of money in this endogenous monetary system. Another element of Meerling's analysis that I find effective is the notion of monetary hierarchy. So different assets may be more or less money-like depending on several factors: the assets themselves, the issuers of the assets, the implications for liquidity servicing, and tensions in global credit markets, especially with the rise of repo funding. So broadly speaking, the types of assets that banks and actors are more or less likely to hold may be shaped by the assets themselves, may be shaped by the issuers of those assets, which will have implications for relative abilities to spend. But it may also have broader implications for spending in the system at large, depending on global security or insecurity, confidence, and so on. And then finally, when we think about new methods of funding credit and so on, the relative extend or withhold liquidity through one means or another can change the pace, can change the time horizon at which debtors are obligated to pay up. So all this will have implications for when liquidity is more broadly extended and when liquidity pinches. So there are two main post-Keynesian approaches to endogenous money. There is the horizontalist or accommodative approach to the money supply as articulated by Basil Moore and Mark Lavoie and others, which notes that central banks accommodate demand for money and cash to meet demand by banks. Banks ration credit through interest rates rather than by hoarding reserves. And Lavoie has argued that the prevalence of overdraft facilities in most financial systems, most monetary systems, stands as evidence of the willingness of central banks and monetary authorities to accommodate effectively all demand for liquid assets. I'm generalizing a little bit. This is in contrast to the verticalist or the structuralist approach to the money supply as articulated by Victoria Chick and Sheila Dow and expanded upon by some others. And this notes that monetary authorities have discretion in determining how much money to put into circulation, what rates to charge, what fees to assess, and so on. And there are links between these. The accommodative view doesn't assume that everybody who wants cash will get it, but notes that the creditworthiness of the potential borrower matters when considering the willingness of the monetary authority to accommodate their demand for cash. In the verticalist or the structuralist approach, liquidity preference stands as a persistent determinant of changing composition of assets and liabilities on balance sheets. And there may, in fact, and notes that there may be times when credit rationing occurs for particular groups or countries or over time. So history, politics, and other factors can matter, can intervene. Structural factors that may affect the endogenous money supply may include banks' relative preference for more liquid assets versus alternatives, expectations about future economic circumstances, so general confidence about the financial system and so on matter, the relative creditworthiness of particular groups or countries depending on the scale or the international scope of the operations, the relative importance of repo operations in monetary policy, and changing perceptions of liquidity and desirability of banks' assets as collateral for monetary operations. Given the increased importance of governments as direct providers of liquidity to banks in recent decades, as well as the increased importance of sovereign bonds in repo operations for banks and monetary policy, I think there is good reason to explore how government expenditure can affect the money supply. And I think that exploring these processes using both the money view of representative balance sheets, as well as Chick and Dow's model of the representative bank's balance sheet, as it may have looked in Keynes's time and updated to better resemble funding mechanisms and so on today, is a useful exercise. So the central questions that this paper explores through a series of very stylized models are the following. What might happen on banks' balance sheets and to money in circulation as fiscal expenditure changes? How do monetary actions facilitate or counteract fiscal actions? Do these dynamics operate differently in different economies? And do tendencies to use new financial intermediation or funding methods change these dynamics? Okay. So Oh no, the figure is not showing up. Well, I apologize. Lend increases at all lending rates while the demand for advances, credit advances remains the same. So if this diagram were showing up, we would have the interest rate on the y-axis, and we would have credit advances on the x-axis. And we would show a downward sloping demand schedule for advances. And the notion here would be that a shift in expenditure that increases deposits as a whole across the economy could lead to an increase in deposits as a whole. Oh, goodness gracious. I don't know if the figures are going to show up. This is really annoying. All right, well, I apologize for that. Effectively, the increase in deposits that results from an increase in credit in circulation may have monetary effects in the absence of tightening by a monetary authority. The quantity of money in circulation, which we're representing here in snapshots as a vertical line, and the quantity of money demanded, which we're going to use just sort of a standard comparative statics downward sloping money demand curve in relation to the interest rate, we're going to assume that the money supply curve is going to shift to the right effectively as deposits are increasing in this system, because effectively in the absence of a counteracting contractionary move by a central bank or a monetary authority to maintain the same interest rate, we may assume declining interest rates over time as deposits rise in the system, as expenditure increases and deposits increase overall. Okay. This is annoying. I'm really sorry. So if you could see the diagrams in the original version of this, the idea would be that it would be representing a bank's balance sheet using the mechanisms that Chicken-Dow map of how banks operated in the 1920s when Keynes was writing. So it was talking about the balance of assets that banks would be inclined to include, which would include some share of reserve assets, some share of other liquid assets, and so on. And the relative willingness of a bank to hold more liquid assets versus extending credit advances to potential borrowers changes depending on that variety of circumstances described at the start of this presentation. So an increase in stringency by monetary authorities that increases the balance of reserve assets a bank is mandated to hold can potentially lead to a decrease in banks' willingness to lend to people across the economy as a whole. Simple monetary hierarchy that Merling sketches out in various works. So we might, and so basically we're going from top to bottom is most liquid to least liquid, or sorry, not liquid, but the idea here is which assets are considered most in demand, most recognized as money, and therefore higher in the hierarchy. So we might have gold or debt issued by the government or a central bank. We might have currency next, particularly currencies issued by powerful economies, currencies used as vehicle currencies around the world. Deposits issued by non-financial enterprises. Deposits used. And then we might also think about assets issued by different bodies as having a similar monetary hierarchy. Assets issued by the government may be considered most money-like, whereas assets and liabilities issued by households would be considered money-like. So when we're considering the balance of assets that a bank may hold, relative worries about the security may encourage banks to shift their holdings. In times of expansion, they may be willing to hold assets lower on the hierarchy, or assets less liquid in times of crisis, and the reverse might happen in times of economic uncertainty. Okay, so effectively, the remaining slides in this paper walk through the effects of government expenditure in the system and how that may change bank sheets. The gist of the paper is thinking about two dynamics. It's thinking about, first, the effect of government expenditure. So what is a bond funding? If the government issues a bond and spends, then that expenditure should show up elsewhere as deposits elsewhere, which generate more expenditure. Secondarily, there are the transactions of the government bond issued to fund that expenditure. So if private investors purchase government bonds, then the private investors' purchase of the bond, in some ways is enabling this is what Marilyn would describe as capital funding of government expenditure, enables expenditure by the government, but way that may be extent of the potential multiplier effects of that transaction. But then if the bond purchased by the private investor is bought, that exchange of funds, more deposits throughout the system. The final, most novel area of what this is starting to get at the end of the presentation, again, I really apologize about the figures here, is flight to assets seen as most liquid. What happens to government viewed as most secure? Well, is enabling the expenditure of a government at home. But if we are talking about an international system, an open system, where there is a rush away from some sovereign bonds in favor of others viewed as more secure, what are the potential negative or perverse implications of that? So what this is starting to think about is what happens when domestic investors reject domestic sovereign debt. What happens when international creditors who have historically been willing to purchase have been willing to purchase particular governments' sovereign debt stop purchasing that, or when monetary authorities change their assessment of the relative risk of particular types of assets, and so on. And I think that this is a really important area of work to continue on. And again, I think use sovereign bonds and other assets as collateral. And also will hopefully allow for modeling the effect of haircuts on sovereign bonds, austerity, conditionality, and other curtailments of fiscal space in this framework. Okay, I'm going to wrap up there. I am in the meantime going to save this presentation as a PDF and reshare it in the hopes that that will show the figures, but I'm going to stop there and allow 5 minutes for Q&A, and I'm actually not totally sure what that looks like in this. I'm not sure what that looks like. Lisa, our ASSA contact person, what does a Q&A look like in this webinar scenario?
It doesn't look like she's here, but I guess perhaps you could put it in the Q&A.
Okay, so what I've done is I have now changed the chat function so that everyone can try to change it so that everyone can ask questions or can share in the chat if they have questions. So if attendees have any questions, or if co-panelists have any questions, I am very happy to talk about them. Or alternately not. We don't have to do Q&A. Does anybody have a question? I'm not trying to be Ben Stein and Ferris Bueller right now. All right. Well, then.
So okay, so I guess okay. So let's try and ask one another questions maybe.
Sure.
Yeah,
okay.
does
So
anybody...
I do see one question in the chat from Ruth Indek that I'd be very happy to answer. And then if panelists have any questions, we can talk. Ruth Indek asks, are there any dangerous situations I see on the horizon now? So if you are able to, Ruth, and you can expand, think of as a potential dangerous situation, I can perhaps, something that I would note approaching is when we think about the CARES Act in general in the US, and we think about, or sorry, I'll leave the CARES Act for now. When we think about the Eurozone, which is the region that I've written most about, where I've thought most about, great, okay. Where I've thought most about the effects of sovereign debt being purchased or not, I have found the response by the European Central Bank to be remarkably reassuring, approaching the okay, I'm going to answer Ruth's question first, and then I'll get to Gary's. I've been reassured by the willingness of the European Central Bank to engage in measures that lessen private creditors' perception of the risk of different European economies' sovereign debt. I think that has had good effects for European governments in terms of their ability to fund and respond to the physical aspect of the coronavirus crisis. I was very worried in March 2020 when Italian spreads started to rise when they were dealing with the worst of the pandemic at that time in Europe. And I think that's really important. As countries move away from perhaps more concern, more potential concern, but I'm going to wait on that. And I'm looking forward to Dr. Dutt's presentation because I think she'll be talking more about areas of greater concern, particularly when considering exorbitant privilege and sovereign debt. Is it too extreme to say that the Chick-per-DAO perspective is not horizontalist? Is that the same as asserting that credit rationing, if it exists, implies that banks can deny credit and that in turn bank credit is controlled ultimately by central banks via banks? Gary, you're picking up on a big insecurity I have about this work that I'm working to resolve based on a conversation with someone else about this project. And where I think the difference is going to come up is thinking about the scenario in monetary sovereigns, or I think that, for example, the US case, where you may see at the federal level in the US, where you may see rapid monetary easing in effectively real time, could basically leave you with a horizontal money supply curve. That the snapshots of monetary expansion in moments of deposits increasing may in fact be as the accommodationist approach to endogenous money predicts. And where I think the difference comes is when we're thinking about the difference between emerging and developed economies. But I think I've talked enough and I want to move on. So we'll come back to this. We can come back to this in the broader discussion. So I'm going to transfer this to Devika, whose presentation I'm really looking forward to. Go ahead.
Okay, great. Thank you so much, Nina. And thanks for the great presentation. You were cutting in and out, which is why, yeah, I had sometimes a little bit of trouble following. I don't know if it was my connection or yours, but yeah, sorry about that. Okay, let me just share my screen really quick. Okay, share. Okay, you said 20 minutes, right? Right. Okay. Okay, thank you everyone for being here and coming to my presentation at this great panel. Like Nina, I look forward to the other presentations more than mine, but yet here we are. So this is part of my dissertation research. I recently finished my PhD now last year in 2021. This is potentially my favorite chapter. I had the most fun writing it, but let's just get into it. So basically the overview of my presentation is that we're going to go into so it's called exorbitant privilege or ultimate responsibility, looking at the access to the international lender of last resort. Obviously I'm referring to I don't think it's Barry Eichengreen who coined the term exorbitant privilege, but he clearly made it popular regarding what it means, the privilege that the U.S. economy has because its institutions are the issuers of the global reserve currency. So I'm not sure if I'm going to refer to all the issues that Nina would like me to refer to, but maybe I do. I don't know. But so yeah, this is effectively referring to the privilege or responsibility that is on the institutions of the United States that issue the global reserve currency as an international lender of last resort. So we're going to go through like a motivation, a brief history, which is why I really enjoyed writing this paper because I delved into all kinds of basically a lot of different documents, which was really fun. I'm going to talk about methodology, my results, and conclusion as per usual. Okay, so basically the main purpose of my paper, which by the way, you can find on my website. I didn't upload it to the ASSA website, I forgot. And the deadline was, anyway. But anyway, so to identify the relative significance of political and economic factors to determine access to the international lender of last resort. And these institutions are basically the US Treasury and the Federal Reserve. The research question is basically which economic and political factors determine the economies that are able to access emergency liquidity in the global reserve currency, which is the US dollar, and what is their relative importance. The contribution of this paper is that it uses qualitative and quantitative evidence to identify these factors and considers the importance of both economic and political factors in this differential access. It also sheds light on how the centrality of institutions of the US in the international monetary system allow it to play a central hegemonic role and further its foreign policy objectives. So I just want to, put in a little throwback to July 2012, with Mario Draghi in the midst of everything going to hell in the European Union during the Eurozone crisis coming out. And this was arguably the turning point of the Eurozone crisis. When he made this famous speech, he says, within our mandate, the European Central Bank is ready to do whatever it takes to preserve the euro. And believe me, it'll be enough. And yes, it was enough because the ECB actually backstopped the debt of various other central banks and other governments in the European Union, in the Eurozone. However, it was able to do that because there was another institution standing behind it, which was basically the Federal Reserve, which is at the time, there was an unlimited swap line. Basically, there was no limit to the amount the ECB could borrow from the Federal Reserve, a standing swap, which has since then been converted to a standing swap facility. And so the ECB could basically, and a lot of like outstanding loans were in dollars. The ECB doesn't issue dollars, the ECB issues euros. And it could provide this emergency liquidity on an unlimited amount because it could effectively borrow it at the time, almost relatively, considering the conditions, relatively costlessly from the issuer of the US dollar. So the key issue here is only the issuer of the international reserve currency, the US dollar, has the ability to act as the international lender of last resort. And so and this, we've seen, like, there's several other papers that identified the effects of receiving emergency liquidity either from the Fed or the US Treasury. And sometimes, like, for instance, Monk in his 2010 paper highlights how often emergency loans from the US Treasury were used as window dressing until such a time an IMF agreement could be agreed upon, because it's still that IMF agreements take time when you're in a foreign exchange crisis or in a currency crisis. It takes time for IMF agreements to be negotiated. But until such a time that they can be, the loans from the US Treasury provided a great stopgap agreement. And sometimes just the act of extending the loan didn't sort of obviated the need for the use of those funds to actually, backstop any currency. Similarly, the mere announcement of a swap line, for instance, ECB speech, I wonder, like, how much of the money that they actually, how much of the loan was actually used to backstop anything, as opposed to just the announcement that Mario Draghi, backed with the might of the Fed, actually made. So a mere announcement can make all the difference. There's a similar instance of the Bank of Korea that I mentioned in my paper, which I encourage you to read, because there's a lot of historical detail that I can't possibly go through in my paper right now. And so these two mechanisms that basically act as international, through which the US institutions can act as international lenders of last resort, are reciprocal currency arrangements such as swap lines, or loans from the Exchange Stabilization Fund, which is a fund on the balance sheet of the US Treasury. Okay, so quick history. So the Exchange Stabilization Fund was created in 1934 on the balance sheet of the US Treasury to make short-term loans to foreign governments that are fundamentally solvent, or for preventing excess downward overshooting of their currency, smoothing their balance of payments adjustments, and reducing output and output and unemployment losses. Very much lender of last resort kind of function. And the decision to extend a loan is made entirely by the Secretary of the Treasury, no sort of congressional oversight, which is basically the source of huge controversy of the use of the ESF, and subject only to the approval of the president. Initially, this was set up, again, this was set up in 1934. So we're talking about, like, sort of different currency regimes. Predominantly of a long part of that period was a fixed currency exchange rate system and the gold standard system, and then Bretton Woods. So it was initially set up to defend the gold value of the US dollar as a counterpart of Her Majesty's Treasury's exchange equalization account. However, it's not been used since 2002 to make foreign loans. It's been used for other things, and we can talk about that if you want to. But between 1962 and 2002, 27 countries received 93 mostly short-term loans from the ESF. Just to move on very quickly to the Fed, so the Federal Reserve has paid attention to dollar shortages globally since at least 1962, when they set up reciprocal currency arrangements or swap lines with 9 European countries at the time. Initially, again, they were used to it was used in both directions, in the sense that the US Fed also borrowed foreign currency, and foreign central banks borrowed the US dollar to kind of maintain the gold value of the dollar at $35 an ounce. And sometimes this entailed, like, trying to alleviate pressures elsewhere so that other central banks don't come calling for to us, to ask to exchange dollar for gold, etc. And basically, after the collapse of the Bretton Woods system, the objective of these institutions became far more ambiguous, because it's not like you have to defend the value of the dollar against a specific amount, like $35 an ounce, or when it was devalued, I forget what it was, $37 an ounce, dollars an ounce. But yeah, so it became a bit more ambiguous. What was the purpose? But just by my count, to give you a sense of the scale of the use, I mean, it's become really popular since the financial crisis in 2007, starting in 2007. However, historically, 32 countries have received assistance through 674 swap agreements. And I'm counting renewals as new agreements. So that's with their respective central banks. Okay, so it's clear that neither the Fed or the US Treasury conducts operation with the explicit objective of acting as an international lender of last resort, because it's not that they're trying to foster stability, global financial stability, at least not explicitly or consistently in the post-war era. However, insofar as confidence in the US dollar is related to the stability of the global financial system, these institutions do de facto act as the international lender of last resort. Nonetheless, they only do so selectively, because it's not in their mandate to do it for everyone, to just alleviate all dollar shortage anywhere. They only do it selectively. And basically the question that I'm asking, which again, I'm taking some time to get to it because yeah, I had to take you through the history. When into which countries then are emergency loans extended from the Federal Reserve or the ESF of the US Treasury? So very quickly with the methodology. So all that detail that I mentioned before, I got from examining some existing literature and meeting minutes of the FOMC between 1962 and 2020 to find discussions in the text among members regarding whether or not to extend swap agreements to other central banks. And so there's like a lot of history in there in my paper, which again I encourage you to read, because from there and from the literature, I identified factors which then form the basis of my like empirical analysis. I mean, it's all empirical, econometric analysis. So effectively, I'm looking at several factors that I classify into economic and political. I mean, let's be real, everything is political economy, but for the sake of argument, for now, I look at the country share of US bank exposure based on existing literature. The argument being that if the exposure of US banks to a particular country's national financial system is too big and too important, it's important for the domestic stability of US banks that country receives, that central bank receives swap lines so that they can stabilize their financial system and therefore by prevent contagion to the US financial system. Then I look at country share in US exports, like what is the share, what is the importance of a certain country's trade to like how important is a country as a destination for US exports once again, so that any downturn in that country could have feedback effect on the US economy, and you know these institutions would want to prevent that. Then I look at country share in US imports, similar argument, foreign exchange reserves. This argument is kind of tricky. You can think of it either way, like do they have enough reserves that they don't need help, and or do they have enough reserves that they can pay us back? I don't know, it could go either way. Share in GDP, in global GDP, how big would be an effect of a slowdown or a recession or a crisis in that country to the global economy, and inflation. And I use inflation because sometimes it's used as a measure of, which is again bizarre, that how good a central bank is in terms of its policies, which is crazy given that what we're seeing right now. But anyway, then I look at political factors. I think this is more interesting. Some literature argues that capital account openness would be important, and it's a political factor because why would it matter to the Fed or the US Treasury what is the capital account openness in another country from the standpoint of a lender? That shouldn't matter. The UN General Assembly voting record, which is in my variable, shows up as ideal point difference. This I borrow from the political science literature. And basically the idea is the closer the voting record of a country to the US in the UN General Assembly, the closer is like some sort of political alliance or political outlook in a sense. Then I look at countries that have trade agreements with the US, defense cooperation agreements with the US, and then look at domestic US political economy. What's the unemployment rate here? Because it could be that it could seem, even though it has no impact on the ability of the Fed or the Treasury to revive the US economy, none of these, the use of either of these instruments has nothing to do with it. It could be politically problematic, and there are cases in the paper that I highlight where it was politically problematic that these instruments were used. So I use US unemployment, and then whether like the party makeup of the US government has any implication, whether we had a Republican president, a Republican House, or Republican Senate. So using all this, I basically, I estimate a panel logit model using quarterly data for a broad panel of developed and developing economies, where the dependent variable indicates whether a country has access to or to either of these institutions between 1980 and 2018. So how I do this, I take Fed swap agreements separately, ESF loans separately, and then I consider them together. Then I consider them, then I also like, so what I do is that, is it just on those bases with these variables, is the country more likely to get any of these loans or not? then I consider, is a country more likely to get these loans when it needs them, when it's in a crisis? So I interact them with a lagged crisis variable, because in an indicator of need. It turns out it doesn't matter because my results are pretty much the same. But yeah, I'm just going to give you a broad overview. I'm not going to take you in the nitty-gritty of the results, because you can see that in the paper, and I don't think it's, the magnitude is that interesting. So basically what we find is that, very importantly, this is just a summary. So here, as I said, the different columns are showing the full model that considered with the lagged crisis variable interacted. Okay, that when I consider economic and political factors, both of them together, we see that the higher the bank exposure, the more likely a country is going to get any assistance from either of these instruments, either of these institutions. That is the case, and that's kind of confirmed what is in the literature. Then I look at, and the other thing that is confirmed is the importance of export share. Higher the importance of a country in the US exports, is more likely it's going to get assistance from either of these institutions. Then I look at reserves, which is weirdly negative. I'm not sure how to explain that. I feel like maybe I have various explanations, but we can come to it. Inflation is only important when it comes to ESF loans, and yeah, I'm not sure. Yeah, it's only important when it comes to ESF loans, and the higher the inflation, the less likely. So again, maybe an indicator of what is bad central bank management. Then I look at my political variables, and I like there's more gray here. That's basically means it's significant and robust, so the result is robust. I do several robustness checks. I look at different models with linear probability and probit, and so yeah, this is the gray stuff is because of that. Sorry, I should have explained that before. So you can see that as predicted, we find the closer the voting record, the lower the ideal point difference in the voting record in the US General Assembly, the more likely is that a country was going to get assistance from the Fed or the US Treasury. The higher the capital account openness, this is for swap agreements, the more likely is a country going to get assistance from either of these institutions. And also the case for if a country has a trade agreement, a defense cooperation agreement, or there's a Democratic president or a Democratic Senate, or Republican House. So I'm not sure how to explain this, but we can talk about it, and I'm going really quickly through it. But basically the picture that you should take away from this is that it's not only that the economic variables are important, but a lot of these political variables that should have nothing to do with the decision to make this loan are also important. I know this is kind of like, to people, I guess in this audience, it's like, gosh, duh. And when I talk to like non-economists, it's like, yeah, obviously things other than economics are important, but we're economists, so here we are. Anyway, so just again, another sort of summary. So you can look at all these results are in my paper. I didn't want to go into too many detail because there are a lot of them. I just look at sort of just to get a picture of a summary of results. That this is effectively telling us the same thing. So this is showing me the marginal effects of variables and the probability of assistance from the lenders of last resort, looking at swap lines, ESF loans, and then looking at them together. This is obviously, the red line is obviously 0, and those are confidence intervals, 1, 5, and 10%. And yeah, I guess I should have shown this to you before. The main takeaway here is, again, like, our political variables are still pretty important. In some cases, the marginal effect is, the magnitude is higher when we're looking than the economic variables. Okay, so I have, according to my count, I have 2.5 minutes, so I'm going to go real quick. So, what I did was, in addition to this, okay, so we did our usual econometrics robustness checks. I thought it would be good to sort of take a closer look. And so this is more sort of qualitatively. I mean, I guess this is the equivalent of doing a fixed effects model on the countries that received this assistance several times, but I'm doing it qualitatively. So some countries receive swap lines on some occasions and not on others. So I think that's a good sort of laboratory setting to examine my hypotheses, like how important is bank exposure, how important is share of exports, capital account openness, etc. And so here I'm just showing you like some cases. I took South Korea, New Zealand, and Brazil to be, they were some of the cases that were interesting and important, and I explained why I've used this sort of these three countries. But I mean, so my analysis in this is not based on just these three countries, but I'm just showing you what I'm talking about here. So the blue shaded area is when these countries were actually in crisis and therefore needed, were in a currency crisis and therefore needed emergency liquidity. And the gray area is when they actually received emergency liquidity from the US institutions. And so you can see that, and this line is looking at bank exposure, share as a total of US bank exposure. And you can see that from when South Korea needed it, like during the East Asian crisis, to when it actually received it during the Great Financial Crisis, and then during COVID, the US bank exposure, the share of total global bank exposure was lower. Similarly, in New Zealand, you can't really see it, but it's also the case, also in Brazil. So clearly, like, there's a complicated picture that's emerging. And I do the same for share of exports, and, you know, like, it's coming contradictory results to my econometric analysis. Same with capital account openness, or at least in some cases, same with capital account openness. So I do this more systematically with sort of looking at averages in these specific cases. And so, you know, again, as I said, I'm doing it with descriptive statistics. I could have done this econometrically as well. I just enjoy doing this better. And so the picture that emerges is that even when I look at all cases, not just those three, we find that, you know, bank exposure is actually not that important, because you can see the cases of when countries that received swap lines from the Fed, the bank exposure mean was lower than when they needed it and they didn't. And so that can't be the only explanation. Similarly with export share, like export share, there's no difference. But basically a lot of these this descriptive analysis of the countries that receive this help more than once is complicating the picture a little bit. Some of my results are supported, some of them are not. But basically, I do the same thing for ESF loans. And again, I find the same results that, like, some of my, like in this case, it sort of confirms all of my econometric results. Counterintuitively. So I'm just saying, like, there's definitely a complicated picture, but I'm already out of time, so I'm gonna finish this up really quick. So basically, the main takeaway is that factors such as US bank exposure, US share of exports play a role in determining, and reserves play in determining which countries have access to ILLR institutions, consistent with the literature. However, there are several political factors that are also very important, specifically higher capital account openness, trade agreements, defense cooperation agreements, unemployment in the US, and the party composition of the US government. The note of caution, which is what I just very quickly took you through, is that the decision to extend emergency liquidity may reflect some kind of like geopolitical hysteresis, that once these institutions decide to extend support to a specific economy, the evolution of the specific variables might matter less. So it might mean the difference between, like, when they decide for the first time, that's when it might be that these variables are more important then, and after that, it might just be more of a hysteresis unless something changes dramatically, which was the case in, for instance, Venezuela received several loans from the ESF until 2002, until Hugo Chavez. So, you know, why does this matter? I think this matters because clearly these are the only, these institutions are the only institutions that can play this role. However, they don't, like, typically, as Kindleberger says, they have the ability, but only like selective willingness. And therefore this generates this huge global inequality, in which countries have to resort to other less effective and more expensive measures to deal with global volatility, such as accumulation of reserves. And in addition, we can see that it's also sort of furthering US foreign policy objectives under the garb of like emergency assistance, which is again furthering US hegemonic goals, which again, apart from just the value judgment of it, even if we remove that, is that it's a threat to global financial stability. So yeah, we can discuss further where I'm going with this, and because I'm developing on this work further. But yeah, let me know if there are any questions. I think I took about 3 minutes more. My bad.
I think that's okay. I really, really enjoyed your presentation, and have some thoughts that I'm happy to share in the post period. So I see one of our co-panelists has a hand up, and I also invite people who are attending to put a question in the Q&A. Nathaniel, go ahead. We have 5 minutes, so at 11, we'll shift to allowing Nate and Alex to present. So go for it.
Well, and I'm sorry, maybe I'm making a mistake here. Should I wait until after everyone's done and we have our little discussion?
Well, we don't have any questions in the Q&A queue, so I would say go for it.
Well, I'm really excited because this is a new literature for me, I admit. And so I'm excited to have an expert here to ask my questions of. I really enjoyed this paper, and I need to work through reading your written draft, I think. But I had just two quick brief questions that are sort of related. One is that, you had this negative effective reserves, and I guess I'm wondering, to what extent is that really just them saying you should use your reserves before you get access to a swap line, and that's related to this like really interesting, and this is I bring this up, I guess, in the paper I'm about to present, but like this literature that's, as I say, new to me, but where they're basically trying to argue that the European swap lines are actually an indication that the US has lost monetary power because they don't extract any concessions in offering these swap lines, which is interesting, nor do they demand that the reserves get used. And so I'm wondering what you make of that. I find myself skeptical, but I want to hear what like a real expert has to say about this.
You flatter me very much by calling me a real expert, but I do have an opinion on both of those. So with the first one, I'm not sure how important are the level of reserves in determining whether a country gets access to these loans, because especially with because either of these cases, it could be that I've accounted for all endogeneity concerns. There's no reverse causation for the most part. But at the same time, it should not be relevant, because it's just that, they could have already used some of their reserves, and that could be a depleted level of reserves because they're already in a crisis. So that could be that central banks have already used up their reserves. So I'm not entirely certain like how important it is. And I mainly sort of included this variable to make sure I was consistent with the literature and I was not ignoring it. And I couldn't like further ignore it because I did get a significant result. It's still a puzzle to me, honestly. Like, that's not a satisfactory answer, but it's very much a puzzle to me because to answer your second question, because a lot of these countries, I think, don't need to accumulate reserves at all anymore, and therefore have very low levels of dollar reserves. In fact, a lot of the countries that actually get swap agreements or have historically received swap agreements or emergency loans, not so much emergency loans, but definitely swap agreements, most of the reserves are in the form of gold. So not even like liquid dollar assets, but like gold, which again, it's not liquid, but it will take a certain conversion into the relevant currency for that, or relevant instrument for them to be used. As far as if US has locked the plot to the Europe, I find that hilarious. But I mean, I'm not trying to be disparaging, but at the same, because I think it's partly that, yes, like right now, because the banking system is so globalized, it's definitely very important that it's not so much a concession to Europe, but mostly that, let's see, like what would happen if there wasn't a swap agreement at the time, back to in the Eurozone crisis. It would have been complete pandemonium in Europe, and at the same time, it would have had blowback on the US economy. But in addition, like, let's look at all these political alliances, right? They also have very important military and political alliances, such as NATO, and their little agreement of like who nominates IMF, who nominates World Bank heads, and somehow they're always pretty much mostly in sync in all like arenas. Usually they're usually like not. So I'm not sure the concessions are necessarily the pound of flesh is kind of extracted in this sort of quid pro quo at the moment manner. In fact, that's the IMF, and which is why the IMF is such a failure when it comes to thinking of being an international lender of last resort, because, as Bagehot's rule, like when you need liquidity in a crisis, it should be lent freely at a premium against good collateral. So at that time, you can't be extracting a pound of flesh, because then it'll reduce the effectiveness of what you're trying to do. But again, in a longer term, the fact that like everything else aligns, I do think is still the US calling the shots. I mean, just as one example, there still are a few holdouts where it comes to the IP waiver and the COVID vaccine and the WTO. But the moment the Biden administration backed the IP waiver, there were several dominoes that started falling, even in Europe, and sort of like stopped their resistance to what they have held for decades, or 2 decades since TRIPS has been in force. So I don't buy it. I don't buy that argument, honestly. Yeah.
Okay, so we have one question in the Q&A, and I'm going to suggest that we let our next 2 panelists go and start accumulating, and I apologize for having answered more questions on my thing, but how about we let Nate go, and then Alex, and then we'll come back to more questions in the time that we have. Sound good? All right. Nathaniel, you are up.
Sure. Okay.
You have 20 minutes. I'll send you a message in the chat when you're at 5 minutes. And
okay. All right. So let me. And then can I ask, have I got it right? Are you guys seeing the presenter view, or am I?
We're seeing not your view.
Okay.
What we're supposed to see.
Great. Okay. Well, so I do have to say this, this presentation comes with 2 disclaimers. One is that, much like the swap line literature, this is me stomping or us stomping through a literature that we're sort of broadly unfamiliar with. This is an excuse, really, to get to know a literature. So I think that means that we are really interested in comments from panelists and audience who are more familiar with this literature. So yes, this is an exploration in particular of international political economy literature. And specifically, we're asking about the way in which this literature conceptualizes monetary hierarchies. I suppose I could pull any number of quotes here to illustrate the sort of core conundrum here. Merling has a particularly unique way of describing this, but of course there's many versions of this. But the idea essentially is that for economists often, and hopefully in this panel or in this room, I'll have some sympathetic members, but that economists very often are rightly accused of not taking money seriously. And the conundrum here is that there is very much an observable, sort of undeniable hierarchy in money, in currencies internationally. And so how do we reconcile that with the relative flatness of money in economic theory? In particular, I guess the question here is, how does this conundrum get resolved in the IPE literature, which very specifically is trying to combine insights from international relations and political science, which have no problem in some sense recognizing these hierarchies, with the economics literature that sort of struggles a bit, I think, to take account of hierarchies. Okay. Right. So yeah. So if liquidity is a free good, then these hierarchies don't make a lot of sense. Let me figure out how to change my slide. Okay, there we go. So yeah, the question is, how has IPE resolved this tension? And in particular, one of the things that that we're kind of interested in is, how has the center of gravity of IPE's focus in economics shifted over time as they try to conceptualize monetary hierarchies. I think there has been a pretty significant shift in the economics literature that the IPE literature has sort of cited or focused itself around, and I've been sort of interested in exploring that. So these are the two motivating questions, at least at the moment, for this project. Here is where I have to offer perhaps a third disclaimer. Well, this is a two-parter, actually. The first is that in reading some of the history of thoughts of international political economy, one of the funny things that I've discovered is that there are several papers that warn against ever attempting a history of thought of international political economy because it is such a diverse literature that sort of defies categorization. Ignoring those warnings, I have waltzed in as an economist and decided to categorize. And so and this is, I think, a categorization probably that is uncontroversial to at least some of the IPE participants. The way in which this monetary hierarchy stuff seems to be organized is with a series of contributions that happen in the early 1970s. Some of those contributions get extended past that. So obviously Kindleberger and Susan Strange don't stop writing, and certainly Benjamin Cohen is just ever present. But that this does represent sort of a kickoff both of IPE as a discipline, but also of this sort of specific attempt to conceptualize monetary hierarchy and power. There is something of a lull in the 1980s, and this perhaps is controversial. And so I'm curious to hear for folks who know the literature maybe better than I do, or who are aware of things that I'm missing, whether or not this is an accurate portrayal. But it does seem like there is a lull in this literature in the 1980s. It's not as if IPE is ignoring money. The international political economy is ignoring money entirely, or finance. But specifically, the concept of international monetary hierarchies does not seem to be a focus here. Instead, as we'll talk about, it seems to be more centered around sort of debunking hegemonic stability theory broadly, and trade and security issues, things like that. There is, however, a notable reemergence in attempts to conceptualize monetary hierarchies in the mid-90s and it culminates in the early 2000s with this book edited by Andrews on the international monetary power, with several contributions from major sort of heavy hitters. There is, I think, a notable shift in this literature, as there isn't a ton of literatures after the great financial crisis. I think there's some really interesting things. And I think the center of gravity in terms of where the IPE literature is looking in economics has shifted. So in terms of the sort of early contributions, there are a number of themes here that I wanted to highlight. We'll talk about them in the context of the both Kindleberger and Susan Strange. And the key themes are this idea that global liquidity should be viewed as a public good. That's particularly a sort of Kindlebergian notion. That world money is quite obviously hierarchical, despite the fact that the economics literature, especially at the time, did not recognize it as such. And that money is inherently political, again, sort of contra economics literature. And this, of course, arises, there's a very clear historical context that's going on here. I mean, there's a number of historical contexts that are going on here, but the declining relevance of capital controls, the potential breakdown of Bretton Woods, you know, the rise of Eurodollar markets and things like that. So this Kindleberger literature is really interesting. I'm admitting to sort of discovering Kindleberger's early contributions. His book on the Great Depression I'm familiar with, though I'm familiar more with the 1980s version of it. His initial version in 1973 has some differences. And in particular, his writings in the early 70s are really focused around this notion of liquidity as a public good. So Kindleberger is positioning himself against the economics discipline. He is notable for critiquing both Keynesians and monetarists as he sees them at the time. And he is also notable for offering a, quote, minority view on the organization of the international monetary system. At the time, Kindleberger ends up arguing that the US dollar should be made into a formal international monetary system, so that we should formalize the dollar system. Essentially, he's arguing that the Bretton Woods system gives false appearances of separate international or separate national currencies at sort of relatively equal levels, that instead the world needs a central currency. That currency should be and is the dollar, that private markets have essentially already chosen the dollar as the international currency. And what that means then is that the United States should provide liquidity, be a lender of last resort internationally in a formal sense, so that he actually ends up arguing that the G10 should have representation on the Federal Open Markets Committee, which is fascinating, if completely ridiculous politically. So he wants to emphasize the system is emergent, it's not planned, the global dollar system, that it's chosen by private actors, that public actors should then follow. And then, of course, this ends up getting crystallized into something called hegemonic stability theory, which perhaps other folks around here are more familiar with. Interestingly enough, as any Kindleberger heads will remind you, Kindleberger never used the term hegemony to describe his system. Instead, he is thinking more of a sort of leadership. Monetary leadership is the term he uses. The idea is that sort of private actors are voluntarily participating in this, and that it is the duty of the key currency to provide global liquidity. Susan Strange, also contra economics. I read recently a very funny anecdote from Susan Strange. Apparently she used to run around all the time telling her colleagues to, quote, always attack economists, which is, hilarious, because Susan Strange, of course, is formerly trained as an economist, but then becomes the sort of creator of the British School of International Political Economy, which has a fraught relationship with economics. She provides one of the early, as far as I can tell, one of the earliest categorizations of international currencies, or at least international currency roles. She wants to distinguish her categorization from the sort of normal economics categorization of the roles that money plays internationally as a reserve currency, roles that are comparable to money as unit of account, money as a store of value, and the familiar uses of money. So she ends up arguing that you can talk about currencies as split into top currencies, neutral currencies, master currencies, and negotiated currencies. And what matters more, at least for the short time I have here, is not so much the details of those categorizations, but that she's attempting a categorization where at least one of these categories is very, very explicitly political, and that is the master currency. So that is explicitly thinking of sort of colonial currency areas, things like that are very clearly currency uses that are the result of political domination. Her later influence, and probably lasting influence beyond this, is in terms of structural and relational power, a concept that gets used quite a bit in IPE in general, but then specifically in monetary hierarchy literature. The structural power, as I understand it, is broadly the ability to frame the available choices to states and actors in the system, as opposed to relational power, which is more coercive power to get somebody to do something that they wouldn't have otherwise done. I'm going to return to this notion of structural and relational power later. I think it becomes important, or perhaps lost. So we arrive at the sort of lull in the literature. The 1980s does not seem to focus explicitly on monetary power. Mostly, this idea of something called hegemonic stability falls out of favor. And IPE seems to publish a lot, at least it seems to me, on trade, production, security, and diplomacy. And I feel somewhat comfortable in saying this, despite obviously not being an expert in the IPE literature, because one can examine the reference sections of almost any international monetary power paper, and you will find a gap in the 1980s. There is no literature cited in the 1980s. And that in itself is an interesting phenomenon that I think deserves more explanation that I really can't provide now. And I'm interested to hear other folks' thoughts. So in particular, in this time, Barry Eichengreen contributes a major critique to the hegemonic stability theory concept, where, you know, he ends up trying to reformulate a lot of this stuff into an economist's lens, through an economist lens. And IPE in general seems to be increasingly influenced by economics, for better or worse. So he ends up saying that you should interpret hegemonic stability or global currency leadership or something like that through the lens of the traditional notion in economics of market power. The idea is, can you influence price and quantity? And so he wants to measure international currency power the way you would measure market power for an individual firm, which is very much different than the way in which Susan Strange, for instance, would conceptualize it. I am using here the Andrews edited volume to sum up enormous literature that appears in the 90s. Kirshner is sometimes credited with having the first contribution, but I'm in my office, so I've got all the books right next to me. This is one advantage of doing this remotely. But Andrew Walter, right, is in 91. A little bit predates Kirshner. But I would argue that there's, although there's great diversity in this literature, obviously, that there are some key themes that maybe tie it together, and this is perhaps controversial, but that in particular, power should be interpreted as the ability to delay or deflect costs of balance of payments adjustment. So it's very balance of payments focused. Power should be conceived of as relational, mostly, although they give some lip service to structural power. They don't really interpret monetary power, it seems to me, in a structural sense. They think of it as monetary statecraft very often, and that they are pretty clear and it pretty commonly stated that they adopt from economics the concept, as Devika pointed out, that monetary power derives from the credibility of the inflation commitment, and good governance in general. The idea that we're protecting property rights and rule of law. And in fact, they end up arguing, or at least Andrews ends up arguing in his contribution to this volume, that the monetary hegemon or the monetary leader actually has to be more conservative than any other member of the international monetary system in terms of their monetary and fiscal policies, in order to maintain their monetary leadership. So that monetary leadership is always this very fragile thing. If it gets abused by overissuing currency, if it gets abused by running large deficits, then you are at risk of losing it. This is also, I think, captured in Benjamin Cohen's currency hierarchy, his concept of the currency hierarchy, where he argues that you can rank these currencies as currencies, again, that we're ranking. I would argue that this is a little bit different, frankly, than Susan Strange's, where a currency could play a bunch of different roles. For him, it does seem like, and maybe I'm misinterpreting, but it does seem like he is placing individual currencies at each level rather than having currencies serve different roles at different levels. But he interprets this broadly as a Darwinian struggle. Your level in the hierarchy has a lot to do with inflation stability and property rights and rule of law. Okay. There's a huge shift after the great financial crisis. It is obviously not really sustainable to argue that conservative policy is the determinant of monetary leadership, when in fact it was quite clear that in the midst of a crisis, conservative policy was actually the opposite of what the monetary leadership did and should have done. So there is this that piece of the monetary hierarchy literature seems to have fallen off for good reason, because it is, though there are some folks who retain it. There's some legacy, but in terms of the new literature, it doesn't seem to be as popular, or at least it's contested. And then there's this emerging literature on based on the Grisha's stuff that argues that the U.S. net international investment position is subject to these valuation effects that actually suggest that the monetary power of the United States is threatened. We can talk more about that. I'm running out of time here, so I don't want to go too much, but we can talk more about that maybe in discussion. But it's, I would argue, a shift away from a sort of balance of payments flows view of monetary power, which is significant. In particular, there's another literature that seems to be influenced by Perry Merling, which seems money as a hierarchy of liabilities. And so that I would argue this is the biggest shift in this literature, where it is no longer that monetary power derives from the quality of state governance, which ultimately is related to imperfections, and you know, the possibility of overissue or something like that. But instead, hierarchy is fundamental to the concept of money itself, that money is this ranked ordering of liabilities, and whose liabilities get used as the settlement asset at which level depends on where you are in the hierarchy. And I would argue there is some return of the concept of hegemony. I do not have time to walk through all of that. We should talk about it though. There's the Hardy and Maxfield stuff, which is the national investment position, net international investment position. And then there's the Merling stuff, where he ranks these currencies. The survival is probably familiar to a lot of people, and Nina covered some of this as well. And then I would argue that Vernango is representative of the hegemonic, the return of hegemony in this literature. In terms of emerging themes, I would argue that there's some debate over whether monetary power is best interpreted as statecraft, whether, as we were talking about with this concept of the international lender of last resort of these swap lines, you know, does it matter that the United States didn't extract some concession from offering swap lines, or is it more important simply that the dollar is the settlement asset? So is power structural, or is it a matter of relational statecraft? And then is international monetary hierarchy an inherent feature of money itself, or is it a consequence of varying degrees of responsible monetary policy or broader state policy? Okay, I will end there, and I suppose we'll open it for questions.
Okay, great. Okay, so we have one question / comment in the Q&A, but I also want to open it up to anyone who might want to raise a hand. But Nate, you could also just look at Gary's post in the Q&A if you wanted to respond to that.
Yeah, I'm reading it now. This is yeah, this is very much my sense of what happens in the 1990s to the global, that the methods of economics, in particular in IPE, they start calling it open economy politics, where we are sort of micro-founding these results, where it's methodological individualism and borrowing the tools of economics, and so power kind of disappears in a real sense, or gets reinterpreted at least through a very economics lens.
Okay, and I see that Devika also has her hand up.
I can wait if there are other questions. No?
I think it's all you. Go for it.
Right. Oh, that was really fascinating. Alice. I mean, like you've been not have such an in-depth look at the IP literature, but clearly have been more interested in money hierarchy. I like this last theme that you put in here as international money hierarchy, an inherent feature of money itself. And I guess my question to you would be, one, what do you think about this? And two, if can we think of money like certain, because there are various aspects of our current monetary system that I would argue does mean that hierarchy is an inherent feature of international money itself. However, I think that's contingent on the design of the international monetary system. So I wonder, in an ideal world, can we design an international monetary system in which money is not inherently hierarchical? And so I was wondering, like, if you, off the top of your head, have some kind of idea of what that might look like?
I feel a little bit more comfortable answering the first question than the second. I don't know that I'm, ready to redesign the international monetary system in a flat way. I don't know. What I would argue is that I'm very convinced and find satisfying the general approach of Perry Maryland, maybe not in all of its specifics, but the general approach where that I think is actually shared by a number of post-Keynesians, right? Even prior to this, where the way in which we should think about money is, what gets used, whose liabilities get used as a settlement asset. And in that sense, it is absolutely inherent that that banks use a particular asset to settle amongst themselves, that households and firms use another asset to settle amongst themselves, and so on and so forth, and that it extended to the international scene, that seems to be quite. And that the idea of using liabilities at different levels as a settlement asset also allows the introduction of politics. So I find this a very satisfying way to describe the theoretical hierarchy of money, whereas I would argue for a lot of the IPE literature, there isn't a sort of theoretical necessity of hierarchy. It is almost an accident of politics. And so I think that this contributes a really nice, and then a lot of people have done really interesting things. I think Stephen Morau and Fabian Pape and others have done really interesting things with the Maryland hierarchy and international monetary power. So I do think that the inherent hierarchy is a much more satisfying explanation than the sort of almost historical or accidental or political hierarchy that comes from the previous IPE literature. I don't know if that's convincing to anyone else, but I don't know how to redesign the world so that there aren't hierarchies. I mean, it's worth thinking about. I just don't know how to answer that. Oh, and to answer Mark's question, not so much methods to test the hypotheses of emerging themes, but methods to test my hypothesis that the location of economic reference in the IPE literature has shifted. So I would like to use, there's some really nice new tools out there that allow us to visualize and map the networks of literature citations. So that I could produce sort of literature network maps that suggest, I would argue, that the IPE literature changes its center of gravity in economics from the sort of Eichengreen cooperation and credibility literature to a more dispersed reference post Great Financial Crisis. I think those visualizations would be really useful. As far as testing emerging themes, I haven't thought, but if you have suggestions, I would be totally open to it.
Okay. That's a good note to transition, I think. I should note also that if attendees have other questions about past presentations that they want to put into the Q&A, that would be great. Panelists can always respond, or we can wait and talk more at the very end. So I am going to hand the proverbial mic to Alex, our cleanup hitter, to present on Deleuzian tools in monetary theory. So you have 20 minutes. I'll send a chat message at when you have 5 minutes, 2 minutes, and 1 minute. Go for
Perfect. Sounds great. So I think actually the question that Devika asked is a really good place to start from mine, which is the question of, is monetary hierarchy a feature of money itself? I think the answer that sort of comes out of the presentation that I'm going to give will be kind of yes, but the particular order that any of them are in is itself a kind of contingent political historical accident. But yes, because of the way that liquidity preference operates, basically, is sort of the argument here. But so a lot of what we've been talking about today has been, sort of how do we think through how it is that different currencies, sort of interact with one another, and what kinds of possibilities that makes available to people sort of across time and available to the managers of those currencies. But a lot of times things kind of get hung up, especially when you try to survey the literature, on the fact that there's not a sort of, it's hard to come up with a thoroughgoing and consistent ontology of what counts as money, like what thing is moneyness. There's no shortage of people, sort of out there opining on this. And I'm not trying to give a concrete, I have discovered it, this is what moneyness is, but rather just kind of a fun way of thinking about it that's kind of native to me and is how I've sort of approached things. So we are going to sort of take methodology from philosophy, and I apologize to everyone for using really kind of just strange literatures that you don't usually pull into econ stuff. But I hope it's fun for everybody. That's why I was so excited to present last, because we get everyone talking about, here's the concrete actual implementations of these things. Here's what it looked like for here. Here's what this says about negotiations between the Fed and the ECB. But what I kind of want to talk about is what is the engine that those who are exercising power in the establishment of monetary hierarchy, what is that engine? How does it run? Where does it come from? Why is it there? And the answer that I usually use for myself is this notion of virtuality, right? So ontology is an uncomfortable topic because we all, are, sort of avid Cambridge Capital controversy type people, where we say, sure, economics is a method of mapping, infinite discrete physical objects into a common dimensionless form, and then imagining that they all sort of talk to each other through an intermediary, and that there are real states of the world at present and possible states of the world in future. And what I sort of would like to push back on there is that rather than talking about real and possible as the distinction, talking about actual and virtual as the distinction. So real and possible maps a little bit neatly onto real and nominal, in this sense that there are real objects, and then the nominal values of those objects represent their possibility to be converted into other objects, right? You own something, you sell it, you buy something else. This is MCM prime in Marx. If you think about virtuality as basically something that an object can become just without losing its original sort of objectness in a sense. So, I mean, the example from Hegel is always the seed is the tree is in the seed, and then also the further seed is in the tree, right? It's sort of this looping back and forth. What I would kind of argue is that the monetary hierarchy sort of depicts degrees of virtuality. And so I'm actually going to skip kind of at random through my slides because I think that that's kind of a fun way to do it. And I'm going to skip ahead to talking about things that are closer to what other people have talked about thus far, which is we've seen a lot of triangles talking about where different monies are on different hierarchies and the importance of the establishment of swap lines for ensuring that. But the argument here is basically that more liquid instruments contain the less liquid instruments that they can be transformed into at par within themselves in some sense. So the fact of moneyness, the fact of liquidity of a given asset is its ability to be more or less losslessly transformed to something that is more actual, that is lower down on these hierarchies. And so it's something that's a little bit easier to see in currencies, in the sense that if you're holding US dollars, you can get, liquid quotes you can meet your survival constraint in basically any other currency in the world. If you're holding, we could go all the way down to subaltern currencies like the Ithaca hour and stuff like that and say, if you're holding, rubles, and you need to satisfy a payment in US dollars, if it's a large enough payment, the exchange rate starts to move against you in and of itself, and it doesn't virtually contain the same value in USD from rubles, right? And so that's sort of the directionality of this hierarchy. But where this gets really interesting is in this idea that we're going to go up to this one here, because this has a neat little picture of what I'm kind of talking about, which is if you look at the diagram on the right, you have this is the classic notion of a symmetry breaking phase transition. I'm going to sound like a crazy person here, but the idea is that this top point here, with the sort of dot at the C instead of the L and R, if you cut it vertically down the middle, it's perfectly symmetric. It's the same thing on one side and the other. By the time that it drops down into one of the two minima, if you cut it down the middle, it's no longer symmetric. One side has the thing, the other side doesn't. And it takes the exercise of energy basically to push that marble back up to that top position. And so the idea is that if you are at that top position, you are doing something like issuing USD, and you can drop it to the left and you can use that to buy Euro bonds, or you can drop it to the right and you can use it to buy a factory in China. And those two things are not necessarily symmetrically exactly the same in the same way that the US dollar was in being able to become the two of them. If you're holding, there's a whole bunch of examples of assets and slides that I've skipped so far, which I'll probably have to go back to. But the idea is that you are starting from this position of virtuality and then you are descending to actuality. The question that comes up from that is, why would you ever want to do that? Why would you ever want to own things that are less, contain fewer things in them than the starting position that you're at? And the reason for that is basically Keynes's liquidity preference, because a dollar, you can't eat a dollar. A dollar is a zero coupon perpetual. It doesn't give you interest. It's just a dollar. It just sort of sits there. If you want to make a return per Keynes and per, sort of the starting point of everything that we're talking about, you have to sacrifice some degree of liquidity in order to make a return. You can make a smaller return by sacrificing a smaller degree of liquidity and buying treasury bonds, where you know that it doesn't really risk you that much to push that marble back up the hill. Or you could go and you could buy something completely insane, like a electric or a lithography machine from ASML that's used to produce the tiniest little semiconductors. And so the idea here is that the reason that you would go down from this position of highest liquidity is in order to secure yield. As was mentioned in this previous slide, and I'm going to highlight, from a metabolic perspective, you can't reproduce yourself sort of on perfectly symmetrical objects that don't sort of turn into food or turn into real products or turn into other things. So this sort of speculative virtual stuff has to turn into real stuff at some point in order for it to, allow society to reproduce itself, right? With social reproduction is always the basis of economics. But the idea here is that when you go into something that is insanely illiquid, like a microchip machine that costs $150 million to buy, and takes 2 years for ASML to produce and has the smoothest whatever and everything else from their pamphlet, you are plowing that into that, and you know that there is no secondary market for this thing. But you have the option, instead of converting it back into something that is liquid and that is virtuality, you have the option to produce these tiny little microchips that only this machine can produce. And so, provided that people want those, that illiquidity is what produces a return there sort of in the first place. You are going all the way from the virtuality of US dollars that you have earned as Taiwan Semiconductor Manufacturing Corp, and then plowing them all the way down into the most liquid thing, most illiquid thing, some particular machine that only works in your production process. But through so doing, you're able to generate a return that is itself sort of a return to virtuality. And this virtual actual moving back and forth is kind of how I think it's most productive to think of the sort of MC M prime cycle in Capital One, as not as a forced movement, sort of. And the most basic version of that, right, is the forced movement towards food and metabolism, right? You deprive peasants of their land. Now all of a sudden they have to be wage workers to buy their wheat. There's a force in that hunger that allows wheat to become sort of more virtual by virtue of its allocation. The real problem that shows up, and I have it listed, as EM sovereign bonds here, just as to keep it in keeping with everybody else here, is what happens if no one wants your illiquid thing? This is like the situation where the old joke from, sort of Minsky is anyone can issue currency. The trick is getting someone to accept it. And so the thing is that the monetary aspect of it is in this movement between the virtual and the actual, and the statecraft governance, etc. aspect of it is in being able to position yourself socially, metabolically, productively towards producing things that people, want. And this is, in some sense, the argument for development as an increase in economic complexity, where you produce sort of more things. You don't have to be a swing producer in a single resource. You don't do these other things. You basically create a base of power by being able to satisfy a certain amount of needs. And then from there, you have the ability to fire up this sort of transition from virtuality to actuality and back that monetary production characterizes. And so here's sort of this fun way of thinking about it, which is to tie it back to Deleuze, who has, in his books with Felix Guattari, has this concept of the body without organs. And that's always positioned as this sort of insane thing that doesn't make any sense. And there's, sort of memes about what even is this? But the idea here is that imagine, you have an egg. You don't know what the particular characteristics of the bird this egg will turn into are. You don't know if it's going to be friends with its other birds. You don't know if it's going to discover how to build a nest in an innovative new way that, sort of changes its, survival abilities and things like that. And the idea with the body without organs is that the body has organs that all perform particular tasks. Toxins go to the liver, other ones go to the kidneys. Everything is sort of specialized. And what Deleuze is sort of asking here is, okay, but what if you could dial that back to pre-specialization in order to come forward to a different set of specializations? So basically you have to, in some sense, to change your illiquid position, you have to be able to liquefy it and make it virtual in order to roll it out as a different illiquid position that may be more efficacious. And so this basic little engine that I'm sort of describing as a particular vision of a particular engine that may be running what moneyness is a sort of emergent social way of negotiating how that works. You see why I was so happy to present last, because everyone's talked about what's actually happening. And I'm trying to say, but if you look at all of these different examples together, there's a sense that there's this movement not of opposing forces of power running into one another, but of different agents of different abilities to affect this movement from actual to virtual that are structured by social power. I only prepared for 15 minutes. I know that it's 20 minutes now. I have a whole tangent I can go on if people are interested in that, but I also don't need to. How do people feel?
I would be happy for you to go on the tangent personally.
Cool. So the tangent is to talk about production as establishing that movement between virtuality and actuality in time. And so the idea here is that chapter 17 of the general theory is overwhelmingly concerned with this idea that if you believe that prices are going to rise for wheat in a year relative to where they are now and relative to the forward price of wheat, why would you ever invest in producing wheat when you could just purchase wheat, hang on to it somehow, and then sell it in the future? This idea that all production is a sort of playing of the expected future spot rates against the forward rates for a given thing in a monetary economy. This is sort of the core insight in chapter 17. And what is so interesting about this is that it shows that the way to manage this system in the manner that is the most consistent with the goals of full employment per Keynes, not talking about we're doing ontology and not ethics, is to establish the system in such a way that there is persistent backwardation in the production of goods, so much so that the purchase of the illiquid capital good combined with the running of the illiquid capital good will give you such a strongly backwardated curve in the goods that capital good produces that it will be a better return, risk adjusted, than just parking that money in either speculation on the original thing that you are intending to produce, or parking it in treasury bonds and waiting. And that is sort of the starting point of this notion that the own rate of own interest, is what rules the roost in sorry, I just got this message. Okay, cool. In the general theory, right? Because the idea there is that you will always have long end interest rates that will be generically higher than some aspect of the complex of returns over time from moving sort of your virtual position at the beginning into the extremely illiquid version, which is the capital good that produces the things in future, rather than the moderately illiquid version, which is holding on to the things themselves and waiting for them to appreciate. I'm going to call it here. I don't need those last 2 minutes. It's been fun.
Okay, thank you so much, Alex, and thank you to all of my fellow panelists. I'm happy to open this up initially to people who may have, let's prioritize 5 minutes or so of questions for Alex's presentation, and then we can shift gears to any general questions people may have. Attendees should feel free to put more questions in the Q&A. And if any panelists have questions, I'm going to say feel free to raise your hand and we can have a discussion. We have 11 minutes or so to go.
Oh, I should stop sharing my screen, eh? There's no need for this. Now I can see everyone again. It's so nice.
I'm happy to go with a question, which is, so I found your presentation really interesting, Alex. It's getting far afield from my comfort zone with a lot of stuff, and that's a good thing. And so what I'm thinking about is that tension. I mean, it's like you're effectively saying, so what is it that gets us to move from the top of the pyramid to the bottom of the pyramid, knowing that the bottom of the pyramid may eventually enable us to get back to the top? And your presentation was joyously in the abstract, and I'm curious how you might, for someone who wants more semiconductors, how do you get from there to there?
Right. So, I mean, what you can do is you can do this fun thing like the way that Perry Marilling does the money view, where you can imagine firms as having not just a survival constraint in terms of being able to meet liquidity requirements for things, but you can imagine them as having a quasi-survival constraint that requires liquidity in upstream suppliers for particular goods. And this is something that's actually incredibly salient with the pandemic, where, you think about the reason I use semiconductors is because this notion that automobile companies have huge liabilities that are denominated in units of individual discrete semiconductors in order to produce their cars is actually quite important, because if you are thinking about all of these things as balance sheets, you can also do sort of a materials balance sheet approach alongside of that, which is to say you have to figure out what it is that is needed in the system, and that can be a central planner. I mean, I've long advocated for we have this industrial finance corporation idea that it was a bill from Senator Chris Coons that we've worked on extensively at Employ America. But there's this idea that if you're going to use the machinery of liabilities denominated in arbitrary quantities, you can then use that same sort of conceptual technology to think about what the liabilities of firms in production in terms of discrete physical objects are. And that is sort of at the heart of the notion of developmentalism as a movement up the value chain. Because as you move up the value chain, you are producing for things that are in ostensibly less liquid markets, and thus you can command either a more continued or a higher markup for those things. We think about, for example, Japan, starts out producing sort of really cruddy individual, sort of consumer electronics in the 1970s, and MIDI comes in and says, okay, but look, no one is that illiquid in this crap. Anybody can assemble this wherever. We have to get you all talking to one another about how to build out sort of more interesting and more robust, DRAM chipsets. Because those are something that we project computer manufacturers of the future will find themselves needing to be liquid in order to produce the products they intend to produce. And so if we do that, then we can exchange that liquidity for liquidity in a US dollar monetary hierarchy sense. And so the productive and monetary sides of this are interlinked through something more than just the exercise of power. This is a really wacky frame. I'm fully willing to admit that.
I have a follow-up question, but I want to make sure that other people who want to ask questions have time to do it, and that I'm not just monopolizing time as the panel chair. I don't want to be a dictator.
No, that's your job. We've delegated responsibility to you.
Okay.
I just have a follow-up to what you just said. In this case, are you sort of, and I guess I just would want to know the relationship in your framework between illiquidity and scarcity, and if there is one, because it kind of sounded very close to that.
Yeah, exactly. Well, because I think that. So I had a quote in the presentation, right, from Ken Boulding that, liquidity is the measure of the perfection of a market. And, sort of a perfect market is sort of one that isn't afflicted by, scarcity, so that things can be priced at relative costs. And so scarcity is kind of a limit condition, like a firm facing a liquidity crunch and a survival constraint problem is experiencing a scarcity of liquid assets. Right. So scarcity is a generic condition in terms of like a global economic, like insufficient to meet the metabolic or cultural or life world aspects of people, is then compressed into a notion that scarcity is, because basically the idea behind this is trying to draw all of these things into common terms, and that liquidity as virtuality is a way to use a common toolkit to look at all of these different aspects so that they can be pointed to one another, instead of just saying, this is a hierarchy that is established simply because it benefits these people, and it's one thing meant for one reason, when all of these hegemonic interfaces are sustained by a wide array of actors for a wide array of reasons, and that digging into and sort of dismantling and making them a little bit more fair, it could be helpful to engage them in common terms, is kind of the idea there.
So when I think about this, I'm seeing a parallel with the like early 20th century structuralist story of like, how do we get our economy to produce the things that are higher value, but the devotion of resources away from the known thing, the sure thing, is a risk. And how do we navigate that? How do we navigate that space? How do we make it make sense to do it? And I would never have, I don't think I would have ever thought of that parallel before this presentation.
Yeah, that's ultimately that's at the end of the day kind of a political and kind of a I hate to say it because it's such a shitty thing to say, but it's sort of a markets question, in the sense that it's the way that you accomplish that is you need to be sufficiently sure in your analysis of the thing that is not the sure thing to make it work out. Because part of the problem is that lots of speculative bubbles that have in the long run contributed to the sort of positive economic output of places were interim destabilizing. I mean, it's not for nothing that the blow up of railway speculations in 1873 is, linked to the end of Reconstruction as a particular political economic era in the US. And so is there a way to judge that? I have no idea. That seems terrifying and like it is intimately bound up in living a human life together with other people.
Yeah, we may have a question in the Q&A getting to that.
Excellent. Right. Yeah, that's exactly it. And that's the thing that so everyone's looking at this question in the Q&A, right? Is this, do I have to read it out, or what's the rules here? That's the thing that's so neat, because in sort of Deleuze's thought, right, the notion, I tend to read him as asking the question, his overarching question winds up being, what is freedom? Which is why he doesn't really have a stable political valence. And it's what is freedom in taking account of developments in mathematics in the 20th century. And so this idea that there are time scales that affect these chemical changes or chemical-like changes that you can't unbake a cake in some sense, is a very, very natural way of treating hysteresis, is how I feel. Because certain things require certain degrees of energy in order to push those things back. And the problem is, you can expend a lot of energy to go out and get different cake ingredients. But in terms of baking a particular cake, the section of your economy where you're, sort of grievously unemployed will always be there as an integral. You'll always only ever be able to take the integral under that function for that time period, which is sort of hysteresis and sort of, you can try to make up for things later, but we're moving forward in historical time when we do this. It's sort of an argument that instead of unbaking a cake, you sell the cake you bought and buy some portion of cake ingredients and do whatever it takes to get the difference between the cost of cake ingredients and the cake with the amount that you were able to sell the cake you baked for.
Okay. We have 1 minute left. I think we can still hang out. I mean, the recording will end in 1 minute. So I just want to take time now to say thank you to everybody who has attended. Thank you to my co-panelists. Apologies again for my diagrams not showing up, but maybe that was a good thing. And I learned a lot, and I look forward to thinking more about everything that was here. And I know I got a lot out of everyone's presentations and the questions that attendees posted. Thank you again for showing up, and I hope everybody has a wonderful day. Yeah, onward and upward.
Thanks for
Thank you. Thanks.